Okay, everyone, I haven't done a video in a few weeks, but I just want to go over a quick trade example that happened over the past week. Today is Saturday, November 7th. Anyway, we're looking at the pound US dollar 30-minute chart, and I'm often asked what is my favorite time frame to trade the levels off of. I tend to go for the 30. It seems to be a good compromise, not too fast, not too slow. If you really wanted, you could drop down to a 15-minute or 5-minute, but that's for only the people that can spend a lot of time really focused in on the charts, all right? Uh, with that said, what I want to demonstrate today is that not everything is always a perfect textbook setup. I mean, that's what I really strive for, but sometimes things aren't as clear, but you can still get a great trade, but you just have to have a bit more knowledge of the market, so that's what I want to try to impart in this video. If we look on this example, you can see that the market started selling off towards the red line, which is the turning point up level. So that's where I expect to bounce up in the market. If you look here, we had one swing low and another one. And when I see that, I'm always looking at the indicators below. And in this case, it's the stochastics. And you can see that it's pointing up. So that means the indicator is diverging with what the uh, market is doing. So that is a bullish sign. So then what I'll do is once I see the divergence, I will look for some kind of bullish candlestick pattern. It could be a hammer, it could be a bullish engulfing pattern, it could be an inside bar. All right. In this particular case, I really don't have anything like that. So sometimes what I do is once I notice that the bars are getting near my level, and that's within about 20 pips of my line, the lowest bar at this level, I will basically buy a breakout of that high. Okay, so I'll buy a breakout of this high here. Market quickly rises above it, but it retraces back, which is very common. All right, any market that you'll trade, it kind of stair steps, maybe two steps up, one step back, and you never, well, I shouldn't say never, but you don't always get the price rocketing without looking back after you get in. So anyway, when we look at this trade, took many hours, but eventually reached its goal, which is hit the first turning point down level, which is up here. Okay, and we actually had a trade to the downside off of this. It was a divergent sell setup because the market made one swing high and then another, but notice that the indicators are going down. Even on the MACD, it's doing that. We have an inside bar here. We get a bit of a run down. All right, but not all will fulfill its, the end goal. In other words, going to the level below. But the whole idea is that through money management, you should still be able to get a piece of that. All right. And one last thing I want to just impart in this video is that in a particular case like this, even though your initial stop would be above the high in this area here, if the market is like say 40, 50, 60 pips in your favor, you should never let yourself get stopped out for a loss. All right. In my book, if you're profitable and then you let it turn into a loser, that's like kind of a cardinal sin. You just don't want to do that. You got to at least move your stop to break even. But, once I'm up 40, 50 pips, I'm going to at least lock in 20 pips. All right, so that's it. I got to run. I'm actually heading off to Las Vegas in a few hours, so I'll talk to you, all of you next week. Bye-bye.